Is your real estate portfolio at risk? Leverage is a powerful tool that can help you scale. But if you're not careful, over leveraging can lead to financial strain and force you into difficult decisions. So, how do you know if you've taken on too much debt? And more importantly, how do you fix it before it's too late? Hi, and welcome to another edition of Brian Montross Talks Real Estate. If you're feeling stretched thin with your properties, your real estate portfolio might already be at risk. Leverage is a tool, but it needs to be used with caution. When applied correctly, it can accelerate your growth, but when mismanaged, it can quickly turn into a liability. If you're relying on future appreciation or hoping nothing goes wrong, you're setting yourself up for trouble. A key sign of over-leveraging is high debt relative to income. If your loan-to-value ratio is above 80%, you have very little equity cushion. If the market takes a downturn and you're forced to sell, you may be stuck paying out of pocket. If you have a debt service coverage ratio loan that is below 1.25, you're not leaving much room for unexpected expenses. That's when that unexpected expense, like replacing an HVAC system, can just push you over the edge. Maybe you took on an adjustable rate loan without having a plan for rate hikes, or you're relying on a cash out refinance to cover short-term costs. I often see these investors are the first to get into trouble. Many investors find themselves in trouble when they overestimate rental income and underestimate expenses. Maybe you assumed rents would always rise, but now the market's shifted and tenants are harder to find. Now you're scrambling to cover your mortgage. Or maybe you bought properties with razor-thin cash flow, and a major repair is needed that you don't have the money to fix. If you're counting on everything going perfectly just to stay afloat, you're not investing, you're gambling. Another telltale sign you're in trouble? No reserves. If you don't have at least 3 to 6 months of expenses saved per property, you're vulnerable. A well-managed portfolio isn't just about acquiring assets, it's about surviving downturns. So, what's the real risk of over-leveraging? I feel it really boils down to one thing. If you can't cover your monthly expenses for a few months without the rent coming in, then you're at risk of being forced to sell, which often means selling at a loss. The investors who struggle the most in downturns aren't necessarily those with bad properties. It's those with no margin for error. One of the simplest ways to assess your risk is to ask yourself, if my rental income dropped by 20% tomorrow, or I had a large capital expense like a new roof, would I be forced to sell at a loss? If the answer is yes, it's time to rethink your strategy. If you suspect you're over-leveraged and you're in trouble, don't panic. There are ways to course correct before it's too late. The first step is build a financial buffer. If you don't have a reserve fund yet, start setting aside a portion of your rental profits now. Aim for 3 to 6 months of property expenses so that if rent payments stopped, you're not immediately at risk. Next, evaluate your highest risk properties. Are there any that are barely cash flowing? Or worse, losing money every month? If so, it may be worth selling one of them to reduce your overall debt load. Selling a weaker property can provide liquidity and strengthen your portfolio overall. If your debt load is high, consider restructuring your finance. Can you refinance an adjustable rate loan into a fixed rate one? Can you negotiate better terms with your lender? Sometimes, even stretching a loan from 15 to 30 years can create that breathing room in your monthly cash flow. The key to scaling sustainably is finding the right balance between positive cash flow, responsible leveraging, and maintaining cash reserves. Simply buying properties at cash flow isn't always enough. Investors should always focus on creating value through strategic improvements. This increases equity, reduces your leverage, and allows you to raise rent, boosting cash flow and strengthening your reserves. The most successful investors aren't the ones who avoid downturns. They're the ones who survive them. If your rents cover your expenses and you have reserves, you can wait out bad markets. But if your entire portfolio depends on constant market growth, a downturn can be devastating. A forced sale usually happens when an investor runs out of cash and has no choice but to offload a property. These sales often happen at the worst time, when values are low and the buyers are scarce. Instead of waiting for appreciation, successful investors set themselves up for stability by maintaining cash reserves, strong cash flow, reasonable debt levels, and they find ways to add value. Scaling should be intentional, not impulsive. Growing a real estate portfolio isn't about accumulating the most doors. It's about owning properties that generate wealth over time without exposing yourself to unnecessary risk. Scaling successfully takes more than just acquiring properties. You need a solid strategy. Leverage the expertise of a real estate advisor to help build a plan that keeps your portfolio growing while protecting your financial future. Stay disciplined. Build your reserves. Use leverage wisely. Every move you make should strengthen your financial future, not put it at risk. Do you think your portfolio is at risk? Drop a comment below with your biggest challenge when it comes to scaling safely. I'd love to hear your thoughts. If you found this video helpful, don't forget to like, comment, and subscribe for more tips and advice on all things real estate. Thank you for watching. And once again, I'll leave you with this verse. Be strong and courageous. Do not be afraid. Do not be discouraged, for the Lord your God will be with you wherever you go. This is Brian Montross, your real estate advisor.